Good afternoon, Ian. Welcome to Better Capital Club. You and I have known each other for a long time. How are you doing today?
I'm good. How are you, Jason?
Doing great. Always great to have you. And so for our audience who don't know who you are, Ian, can you give us a quick introduction about who you are? Who is Ian Hunter?
Oh, sure. I'm a financial planner. I do financial advising for clients who are often business owners, and basically, helping people who are, for one reason or another, earning income through a business that they think they will probably want to step back from sometime in the next few years and figure out how to plan for that next phase of life. And so I really go in depth with people on helping them plan that next phase and phasing into the next thing and everything that goes along with that regarding their investments.
Absolutely. I think today we're going to talk about something really exciting about market timing. I know that I myself have often been tempted to market time when everyone posts pulls into a meme stock. I was even though I don't post a trigger, every cell in my body is telling me to get in, to market time.
Yeah.
Um, and today super excited to go over a lot of the mechanics and it's an emotional aspect of market timing with you. So I think my first question, Ian, to you is, do you think that there are a lot of market timers?
Yes, I mean that's actually a great question because it feels like, and it's probably not just a feeling, but there's a lot more advice these days about the market and what should people be doing, what kind of attention we should be paying to the FOMC, the new tax laws, everything that's coming out on a daily basis. It's much more exaggerated than it used to be 20 years ago, 25 years ago, when I first got out of school and was paying attention to the markets. So what that does to us as humans, just that regular onslaught of noise that we get when we open up Twitter, when we go on TikTok now, we're getting advice about what we should be doing with our daily trading accounts. When you can't really escape it that way, it just has this kind of all-consuming effect on your brain. And that's not really healthy for the type of investing that is the best for most of us, which is in a lot of cases, probably in this audience, a lot of people are in the early stages of their career or maybe 10 years away from planning to retire, somebody that is still earning. And so when you're in the still earning phase and you don't need your capital back too soon, you should not be focusing on the economy and on the short-term moves of the market. And I'm sure we can talk a little bit more about that in this conversation.
Absolutely. So and with a long-term mindset, as our goal, I can think of a couple of reasons why the audience should not market time. So I am gonna list out a few that I can think of at the top of my head, and I would love to pick your brains on it. So first of all, I think market timing in general is bad because the market tends to go up over time. It's impossible, for example, for you to hold cash and to know the exact moment that the market is going to dip. A lot of people wait for dips, but the market ends up going up. And it's so hard to, know what the market is doing because it's so dynamic. And my second reason is, transaction fees. So for a lot of our audience coming from the real estate world, we all know how crazy transaction costs are. Even for something very liquid like an ETF or like an individual stock ticker, there's going to be spreads on every trade, and there's going to be some commissions, that you're going to be losing out on. So Ian, what do you think about that?
Those are definitely great reasons. I would say the fact that the transaction costs can be high, it's not even solely measured by the commissions. The transaction cost is actually in your brain. It taxes your psychology when you're constantly moving in and out of the markets. and it has this erosive effect on your ability to have good judgment about your investments. Um, there have been studies where I think it was maybe it's Fidelity, one of the big retail brokerages, did a study a number of years back. They looked at which accounts had performed the best among their retail accounts, and they found that over, let's say, a couple decades, the accounts where there was frequent trading far underperformed the accounts where people had not even logged in. So they weren't even checking their accounts to see what they were. So the conclusion was ignoring your portfolio statistically will put you in a better position.
And yeah, I love what you said, that is the best way to investing sometimes is to forget about it.
Right.
Um, and Ian, do you think it's important to keep track of what the market is doing and the market updates, or would you recommend someone who's not a financial professional to take a more relaxed approach and to ignore a lot of those noises that are coming in?
Well, yeah, I mean, it's a, so I would say that, based on my last comments, that study with Fidelity, the answer is not always necessarily to completely ignore your portfolio. But the lesson from that, I would say, is the more you try to tinker with it, the worse your outcome can be. And what we mean by tinkering is kind of trusting your intuition, or trusting the advice of let's say the social media accounts that you've subscribed to, and not following kind of a rules-based approach. I would contrast a rules-based approach with the uh, taking whatever advice you see on the front of the Wall Street Journal, whatever you see in your favorite newsletter that you subscribe to. What you end up doing when you're taking those suggestions is you're mixing in all those influences with your brain chemistry that can fluctuate for no reason, that has nothing to do with the markets. You might not have had your coffee that morning. You might be subconsciously dealing with stress from your family the day before. All those little factors come into play and can influence when you're trading and what types of decisions you're making. So I advocate having more of a rules-based approach to the investing that you do. And that's probably a topic we could talk about more on a whole other podcast.
Absolutely. So yeah, I can think of a few examples of, specific rule-based transactions. I think namely a lot of people like to rebalance their portfolios either quarterly or annually. They like to be exposed to different assets at a certain percentages. And I can also think of some cases, for, retirees who needs to regularly exit some of their positions at regular intervals, or to dollar cost average into an investment over time for someone that's on the younger side. Can you give us more examples of what is a good rule-based approach to investing?
Yeah, no, you hit on some great examples there. The time to shift whatever is in your portfolio, certainly one of the periodic things that you want to do according to a rules-based algorithm is, first of all, start with a plan. So you figure out, what are your goals for that capital? And as you said, if you're in retirement, your goals for that capital are probably to periodically provide income for you this year, next year, the year after. Someone in that situation is going to have very different goals than someone who is, let's say, 35 and is going to continually be putting money into that. And that person who's 35 might know, hey, I need to have 20 years from now a certain amount of capital to take out for college for my daughter. And then beyond that, that capital is going to continue to need to provide capital for me and my wife. So, I would say the algorithm or the rules to follow for someone in that earlier scenario where you're still building up your capital is definitely, has to do with a problem that a lot of us face when we are business owners, for example. We don't always know how much income we're going to make this year. And so we might get a big inflow of cash in February, and then maybe in May there's another smaller inflow, and then a few months later a bigger inflow. And what that does to us psychologically as humans is it puts us in a position of constantly having to make a decision about a big chunk of cash. And what do we naturally do? We want to seek guidance from the front page of the Wall Street Journal, once that money hits our account. And so then we spend all this time, like a lot of mental energy, trying to figure out what is the right combination of investments I should have. How do I get it into the markets? All those things. So kind of going back to that psychology example we used, when you're making all these big decisions, it taxes the brain. It causes you to make worse decisions when you're having to make frequent, big, stressful decisions. So, long way of answering your question. Dollar cost averaging, which you mentioned, is a form of rules where you have, let's say, let's say you're a business owner, unpredictable income, but you know that you need a certain bucket of cash that is always at a certain level to get you through that uncertain future 12 months. Once that's filled up, your rule can say, then we pour the rest of that capital into something that then buys a specific combination of ETFs, let's say, to keep you diversified. That over time is going to get you through market ups and downs much better than trying to pick the right entry point. And we can talk more about that at a different time too.